In today's video, I will talk about what a recession is, what are some of the key parameters to identify a recession, what has been the major cause that has led to the recession in 2023, and lastly, how I am going to personally create a safety cushion for myself and potentially use this recession as an opportunity to grow the size of my investment portfolio. So first of all, let's understand what a recession is. It is basically a period when there is a slowdown in the economic activity within a country. In 2023 though, a lot of countries have been facing high inflation, reduced consumer spending and negative economic growth. So 2023 can be called the year of global recession. Let me also tell you about some signs that the economists use to identify if a recession is on the way. The first sign is falling GDP growth rate. Officially, when there are two consecutive quarters of negative GDP growth rate, then a recession is declared. In case of India, we saw that the GDP growth rate in the first quarter of financial year 2022 was 13.5%. But in the very next quarter, the GDP growth rate fell to 6.3%. Soumya Kanti Ghosh, the Group Chief Economic Advisor of India's largest bank, SBI, has also lowered the forecast of GDP growth by 0.7%. Also, Mr. Narayan Rane, the Union Minister of Micro, Small and Medium Enterprises, has also said that a recession is expected to hit India in the mid of 2023. The second sign of a recession is increasing unemployment rate. As per Trading Economics, the unemployment rate in India went from 8.03% in November of 2022 to 8.3% in December of 2022. If we look at the urban unemployment specifically, then the rate of unemployment went from 8.92% to 10.09% in December of 2022. The last but not the least, an inverted yield curve is associated with a recession in the near future. For those who don't understand what a yield curve is, it is basically a graphical representation of the interest rates on bonds for different range of maturities. If you see the US Treasuries yield curve, currently it is forming an inverted yield curve. The reason for this is that the interest rate on short-term bonds is much higher than that of long-term bonds. Now that these parameters clearly indicate that there is a recession on the way, let me also share the major cause of the recession in 2023. So the thing is that after the pandemic had impacted the economy in a negative way and the consumer spending was reduced, the Fed decided to use quantitative easing as a tool to increase the supply of money in the market and foster demand. Simultaneously, the federal funds rate was also lowered to a range of 0 to 0.25%. This made borrowing money cheaper and therefore increased the spending power of individuals. But sadly, the effect of this was a very high inflation, to which the Fed reacted by stopping the new money supply in the market and also increasing the interest rates. Usually the Fed has 8 meetings in a year to decide upon the federal interest rate. In 2022 alone, due to high inflation, the Fed has raised interest rates in 7 meetings out of the 8 meetings that were held. Top economists such as Jeremy Siegel blame the Fed and have warned of an extremely high recession. To no surprise, major parts of the world have already started to feel the impact. UK is already seeing a high inflation and a slowdown in the economic growth. The Bank of England has projected that there will be 4 quarters of recession in the UK. Even the top Eurozone countries such as France and Germany are experiencing record inflation, and the International Monetary Fund points out that these economies might face a negative economic growth in the near term. Now, amidst this global recession, there is an action plan that I've made in order to ride the recession with a safety cushion and potentially grow the size of my investment portfolio. The first step is ensuring that there is an emergency fund in place for at least 6 months of your day-to-day expenses. This will help you to not fall on your face in case of a layoff. The next step would be to pay off high interest credit card debt. It is because the interest component on the dues can really pile up and become a huge mess. After that, I would rebalance my portfolio. We know that in a recession, the stock market goes down. So it is better that we sell off our investments if they are in profits and then transfer the money in high yield savings accounts or liquid funds. The reason is that holding cash is much better an investment than investing in asset classes such as equity, which give negative returns during a recession. Most importantly, for all the people who have a job, you must gauge the financial position of your company very well and try not to lose your job. In case of even the slightest hint of a layoff, start job hunting right away. Lastly, in the positive circumstance of you having a stable income from your job and the stock market correcting due to the recession, you must buy high quality, fundamentally strong stocks. The reason is that you will get very attractive prices for these stocks, and these stocks are the ones that are first going to come out of the recession and give you double-digit returns after recovery. I would personally look at stocks such as Asian Paints, HUL, Infosys, Reliance, etc. This is not at all a financial advice, and so you should do your own research and consult a financial advisor before investing. Historically, the stock market has always recovered, and these crashes have been the best days to invest in the stock market to grow the size of your investment portfolio. Thank you so much for watching. Like the video, hit that subscribe button, and stay tuned for my next video.